So firstly, my name's Steve Torsa. I'm the CEO and co-founder of Wholesale Investor. I'd just like to welcome everyone for joining this session. By the way, this is my first time doing a session like this as far as doing a capital raising outlook. So look, my sort of goal for this is I want to be as engaging and interactive as possible. And to give you some context how this come about was that I myself as a company, I've raised capital several times over the last couple of years for Wholesale Investor to basically build Crisp and build out some of our ambitions as far as growing the business across the UK and creating an opportunity, on the capital side, etc., and funds management. And always I'm sort of in my head asking myself that question of the timing around capital raising. And when I started doing a deep dive into, effectively what was actually happening in the marketplace and in the ecosystem and just in sort of VCs in general and high net worth, it really started to help me form an opinion on what was no problems, Vin, happy to. Really help me start to form an opinion on what's going on in the space. So I hope that instead of preparing this, and for me, when I sort of thought about doing this, initially I actually wasn't going to do any sort of presentation, but then I just thought, you know what, I may as well provide what I'm seeing sort of externally, as well as give perspective on what we're seeing internally with Wholesale Investor. So as I said, I hope you do find it of value. If you find it absolutely boring, I apologize. But like I said, my goal is that, at least for a lot of you, you may be thinking about a capital raising. Welcome, Mira. And please put in the chat. Obviously, I want this to be engaging as possible. So to start off, introduce yourself and just mention where you're actually joining from. I think it's really nice. We've got quite a few people on the session tonight. So, it's always good to hear from other people who are joining. So welcome, Mira from Sydney. So look, I'll kick off and go look for some of the agendas. Hey, Jeremy, welcome, mate. For obviously a bit of an introduction, I'll talk about some of the VC trends from 2021. I'll talk about it from an international perspective, and then also talk about it locally. For me, I suppose there's a few different factors which have been going through my head, and I've been observing what's happening in the general market. I've been observing what's, when I talk about market, I mean the listed space and also just macro levels as well, like as far as inflation, interest rates, etc. And then I can go through what I'm observing personally on our own platform. Welcome, Suzanne from Adelaide. Great to have you here. And then I'll talk about the outlook for sort of 2022. And then the last part is just something really interesting for me to share. It's just something that I've been doing some work on for the last 12 months is that I think now's a really good time as the convergence of innovation and generational trends. And I think it makes a difference for companies. So my hope for this is that you walk away with a perspective for your own capital raising. And I assume, for most of you, out of curiosity, for people that are actually joining the call, just put a Y, just put a Y in the chat box. Welcome, Key from Singapore. Just put a Y in the chat box. If you're thinking about raising capital in the next 12 months, just put a Y in the chat box. Okay, just to give you some ideas. There's a lot of whys coming through, right? So I hope this gives you some sort of perspective. And to be blunt, I went down this path selfishly for me. This is why I sort of kicked off down this path. And look, a lot of what I've learned from having an investor hat has really helped me on the business side. So let's get into it. So I won't go too much more about me. Obviously, I founded Wholesale Investor, now got offices in Sydney, Perth, and London. And look, everything WI does is about connecting emerging growth companies with high net worth investors. And for that, we utilize technology, platform, and partners. I hope that gives you, hi, welcome, Brian. Okay, so our sector experience is across pretty much every sector. So I said everyone has different questions for us about sectors, but we've worked with a lot of them. And we worked with companies from every stage. So when I provide sort of our guidance, it's really very general because we do work companies across many different stages. But said I want to make this as engaging, as interactive as possible for you so that you can get value from it for your own thesis and your own thinking and your own strategy. And this, to give context, right? So this is where I suppose why I started my deep dive, and this always sits in the back of my mind. It's a famous TED Talk from 2015, as you can see. It's from Bill Gross. And he talks about the reasons for startup success. And if you haven't watched it, I highly recommend that as soon as we finish this session, I recommend you go and watch it. But first he basically looks at when he looked at his sort of 200 investee companies and he looked at some of the most successful companies of that period, he sort of wanted to do a breakdown. And he looked at it in 5 different areas. So he looked at effectively, what was the difference that makes a difference across the idea, the team, the execution, the business model, the funding, and then also the timing. And effectively, when they looked into it, 14% was connected to funding because there was plenty of well-funded companies that had actually failed, right? And then they looked at the business model. And the reality is, like, as a business grows over time, the business model typically adapts and changes to suit the customers. And, it was said for us, you see it now, a lot of SaaS businesses, because that's effectively the business model that's been obviously funded, but also it's a business model that consumers also want, the subscription-based model. The idea part, and I know as most sort of startups and most founders, they really focus on the idea, but really the idea was only just one component. And you'll find as you go through these different stats, happy to share this at the end. We're actually recording this as well, Miriam, so FYI. And good to see more and more people still coming on. And then the idea was one part, and look, you realize more and more, and I'll show you this in some of the stats. It's showing that, effectively at this stage, the idea isn't enough, right? An idea is only one component for companies that are raising, and I'll go into that. Team and execution was the second top component, right, for the reason startups succeed. And obviously teams change as you go through the growth phase. The real key one, and this is what always sits in the back of my mind when I think about this as a session, I think about my sort of outlook and my thesis for myself, right? And then I said, you can take from that whatever you will in your own sort of general thinking, but timing is massive. I see this over and over again, right? So if you think about the boom that was buy now, pay later in the sort of last, 4 years between just sort of 5 years, between 2016 and 2021, there's a beautiful saying that there's a rising tide that lifts all boats, and timing is absolutely spot on with that. Right now, renewable energy technology is through the roof, and because its time has come, and there's a whole bunch of different factors for that. So I am always really conscious that timing is everything when it comes to raising capital. And there's sometimes when your sector is in the spotlight, and there's other times when it's not. And the reality is when the area that you're in is in the spotlight, it is time to run as hard as possible, right? For whether it be for the growth of the business or for accessing capital. If it's not, then you just realize you could have a tough period ahead of you, and it's going to take time, it's going to take effort, and it's bruising for the ego. And you sort of can't understand why, what you think you're doing is so amazing, but other people aren't quite getting it. Sometimes it's just simply timing. So, I'll kick off and I'll go through some of the things we're seeing in venture capital activity. And I'll also mention my sources as well. So for future reference, you can go and check it out. You can get this access. You can access the exact same information that I accessed for this. There was nothing special about it. It just helped me shape my thinking. So the first one is from FactSet. They're basically looking at sort of global venture capital activity. And I found this really interesting where it sort of covers across North America, Asia, Europe, and I'm not sure what row is, but effectively, if you look at it, you can see that whilst there was a dip, sort of at the start, like you look at sort of 2019, 2020, and then look at 2021, I thought, thanks for that, rest of the world. Effectively, it was small, so I didn't really think to dig into it too much. But basically, I find it really interesting, you see how much it's actually grown in 2021. And a lot of that's got to do with the amount of stimulus that's actually being pumped into the ecosystem. So the rates were already high compared to where they were in those previous 3 years, but you effectively see that globally, venture capital activity is actually going through the roof. And in some cases, it's actually doubling. Like if you look at sort of North America and Europe, it's effectively doubled in that period. And then if you look at Asia, I think it's up about 65% something, in that period. So really around the world globally, there's more and more money. And there's been literally trillions of dollars printed and actually invest and basically thrown into economies around the world. And there was a period, if you look at sort of 2021, where people had so much excess cash that they needed to invest it somewhere. And obviously with interest rates at record lows globally, no one's like in some cases in Europe, you actually have to pay to have money in the bank. effectively people are looking to investors are actively looking to invest their money, right? There is literally no value in having cash in the bank these days unless you think the market is about to fall, right? So I think it's a really interesting thing to understand from a perspective. And then what I also found really interesting was the amount of unicorns that were created. And if you look at the massive surge across 2021, you can see that pretty much in every region, there was a significant increase in the amount of unicorns that were created. And once again, that goes to speak to how much money was actually invested into basically the trillions of dollars that was actually invested, or sorry, I shouldn't say invested, was printed and put into economies around the world. This also I found super interesting and once again, this is all from FactSet. It's actually a really good article that I got all this information from, but really technology, financial services really drove it. And then you got commercial services and health tech and then retail trade. Now, for me personally, I thought retail trade would be a lot higher, but really and obviously whether that's been counted as the online platforms, what I found super interesting was just how much increased amount of money has actually gone into fintech as well. The fact that it's second. In the previous year, I think it was fifth. And then now it's actually moved up into second, right, as far as a top area. And you're looking at this sort of technology services is absolutely through the roof. And I think as I go through the presentation later, it will start to actually make sense and help you understand why. And also, I know that while some of you are raising capital, you're thinking about, okay, well, when is the time to raise capital? What I hope you take away from this also is some additional thoughts around your own business model and actually effectively ways to expand the opportunity that may be in front of you going forward. I think is probably the best way to put it. So, to me, that really blew me away when I saw how much was specifically in technology services. Now, from a volume perspective, I also found this quite interesting looking at the stages in which people are actually investing. Now, if you break it down and you look at the dollar volumes, you'll see that really there's not that much growth actually in the angel and seed area. Right. And then likewise, there's a bit more growth in the early stage, where actually the biggest growth in actual capital was in late stage companies. And you'll see this as a trend as I go through these different stats. And by the way, feel free to ask questions as we're going through this, but you may want to wait till later as I'm just going through these charts. But effectively, like the late stage growth is really where a lot of money was plowed into. And I found that interesting. So it shows the year-on-year change and the quarter-on-quarter change, etc. But you can see that, for angel seed businesses, there's not a lot of additional capital going into it. And whilst that's only covering the last sort of 2 years, you'll see that even at the global seed and angel, the actual number of deals dropped, right? The amounts increased a bit, but the actual number of deals dropped at that angel and seed stage, which, does that mean you sit there and go, okay, should I be freaking out if I'm an angel and seed stage business? I just think it's something to be aware of for going forward, right? And also to think about how you need to plan and time your capital raising and what you need to be talking to, right? So, Samir, a bit early for the self-promotion. And so this one, as I said, one of my favorite sources recently that I've come across, and I saw them featured in the AFR, but Cut Through Ventures do a great job of sort of publishing deals. Now, this covered December 2021, right? But also they cover information really, like this was a specific chart that I found super interesting, was it when it flagged the amount of capital raised throughout last year. And you can see that typically January is a very slow month for capital markets, right? But it really starts to peak around, as you see, July, and then just September obviously is massive, and then through December as well. But what are we all kicking off the self-promotion now? You may want to save the self-promotion to later if anyone's promoting. This is just an information session. There's nothing to promote on this. Effectively, you can see the top segments. Now, I found it personally interesting how marketing and customer success was one of the top 3 segments for December specifically. And you look at the size of the deals, and this is just Australia, by the way, this amount. 80 deals, and it was 1.325 billion, and there was 13 deals for crowdfunded, which was 23.1 million. Now, crowdfunding obviously really suits sort of B2C type businesses, and you'll see that, and I'll highlight something because equity crowdfunding has grown a lot over the last couple of years, and that's in line with really people's discretionary spend. So anyway, I found this super interesting, just the nature of how deals progressed throughout last year. I think it's important to see because at the start of the year, last year, they had the same concerns around sort of about the potential of interest rates and how it may actually affect the markets going forward. And what I don't think a lot of people understand in the small cap space, in the private space, is that we're actually a lot impacted by what happens sort of in that sort of small to mid cap tech space, and also how interest rates and inflation can potentially impact our capital raises. So I hope to give a bit of a picture on that as well. The other part was just looking at the states. I found this super interesting. There's different variations of this, but I found it really interesting that the majority of capital raised in December was actually from New South Wales, and it was just over $1 billion. And then you can see that it's significantly less across the other states. But I just found that stat interesting. Now, this is my other favorite resource, and Peter's done an incredible job over the last few years of actually pulling together resources in this, really basically getting information about what's happening in the venture space. Because literally before Peter started provided this information through TechPort, this space was fairly invisible in how things were done. So I highly recommend to register on TechBoard and get their information as well. So, okay, you can see that the amount of deals, just look at that difference in deals. So that same trend that you saw with sort of global VCs and private money, we're also seeing now in Australia, where there's obviously a lot of young tech companies, and you can see that he highlights really well that the money raised between 2018 to 2020 was absolutely dwarfed. Thanks, Jeremy. That's the way to do it. Promote the people that I'm talking about. There was actually more money raised in 2021 than what was raised from 2018 to 2020. And there's a few factors that I look at that and I think about that as an opportunity for all of us going forward. Oh, Peter, you're on the channel. Nice, mate. I say it is good data. That's why I like to use it, Peter. It was actually your email recently that you sent out. Anyway, I found this really interesting about how much growth was actually in this area just in the last year alone. Now, moving on from that, when you break down the different quarters, you see that typically, and this was when really, I suppose, from a money in the ecosystem perspective, it was actually at its peak. And this was across several key areas. But when you look at sort of how the year played out last year, it's fairly consistent from what you see in Australia and also what you see globally. This was the one that really surprised me. As far as Pete, if there was a stat that you've done that I saw and I thought, holy shit, that's interesting, it was this one, right? So one of the things that I've sort of observed when it comes to funding is that it seems like over the last couple of years, a lot more money has been going into later stage companies than more so into earlier stage companies. And I get that, yes, there's bigger funding rounds in the later stage companies. But when you actually look at this, it really puts it into perspective how, if you look at companies raising up to $1 million, literally almost nothing has changed, from 2017, 2018, right? And if you look at companies raising from 1 million to 5 million, there's a bit of an uplift, but it's not as much as what you'd expect across a 5-year period. Where everything truly transforms is at the higher stage, when you're going from companies raising from 10 million to 20 million to 20 million to 50 million, etc. And I think what this really communicates is that for companies at the early stage, you've basically just got to absolutely work a lot harder to raise their capital. And so Peter's just highlighted, I don't know if he's saying to everyone. So Peter's just highlighted that a lot of the deals that happen at this early stage can be actually invisible. And actually, it's a good point, because I'd say even sort of 1 million to 5 million, but still, I still find it interesting that the lack of growth in that area. In saying that, there is a lot more companies that are actually raising than was at that time. So even if they are invisible or non-newsworthy, you'd still expect to see some sort of lift for that range. But to me, even 1 million to 5 million is still newsworthy. So I would, from my perspective, I still find it interesting that the biggest gap, the biggest difference really that you see over the last 5 years is companies raising 20 million and above, right? That's where you're seeing the largest amount of money going to. So, and I think for any company that is thinking about raising capital, it's a good thing to know that pretty much, and this is like with everything, the hardest stages are actually the hardest stages are always the first stage. Like there's a certain failure rate at every stage of raising capital. My team actually found this amazing stat where at each stage of raising capital, whether it be from seed to angel to Series A, Series B, etc., there's approximately an 80% failure rate for companies at the different stages. What is good to know for any company is if they hit that point of going past that sort of 20, there is a lot more capital available to potentially be invested. Thanks, Amir. Okay, venture capital opportunities. So this is my sort of summary of looking at this. So effectively, what's really nice about the ecosystem at the moment is there's a lot of gains that are actually being recycled back into it. So if you look at the top level, obviously the Atlassian founders have started their own family offices, they're backed VC funds, they're backing accelerators, etc. One of the best things about this space is the more it grows, effectively the more that actually gets recycled back into it. Like, no, I've never heard of any founder that's built a company, sold out, and then never invested back into another startup or into another fund in this area, etc. The entire space recycles and reinvests back into the ecosystem. So I think for all of us to know that over the next 5 to 10 years, we are going to see incredible growth in our actual ecosystem because effectively there's a lot more money being made, there's a lot more transactions being done, there's a lot more companies being listed, there's a lot more companies being sold, etc. And when those gains are made, they get reinvested back in. There'll be increased personal investment from high net worths. I've noted that people that I would never have expected that really are consistently looking for how they can invest another sort of 50 to 100K into different businesses. And you'll find that's typically going to be the sweet spot for high net worth investing into businesses is typically around that sort of 25 to 250. So Samir, apologies, I don't have stats for India for my session. But yeah, so for me, I've seen a lot more increased personal investment from the high net worths coming into the space, and that will also continue. Now, the difference is that when people think about high net worths, what I'm also observing is that they're typically investing less money across more companies. So where they may have invested 500K into one company, they're now investing 100K across sort of 5 companies. And I must say, if you participate in any sort of angel workshops or anything like that, they're typically giving that sort of guidance to high net worths as well. You still do have family offices investing that sort of $500 or $1 million plus sort of into businesses directly. I just find that high net worths is typically going to be around that sort of 50 to 250K mark, typically from an investment size. The other one, you will notice that, and Peter probably has stats on this as far as how many funds have been launched. Over the next 5 to 10 years, there's going to be a lot more funds launched. Even this year, there'll be more funds launched. And likewise, you'll see an increased amount of syndicates. So definitely over the last 12 months, I've seen a lot more syndicates being formed where effectively what it's doing is it's organizing investors together to participate in opportunities. So typically you find with a lot of the bigger companies, like if a company is raising 10 million, they're not that keen on accepting 50K checks. However, when syndicates get together, they're able to group together, 50K amounts from a range of investors and then put that $2 million in as one investor for it as well. Sanjay, can I just ask to stop doing promotion of your projects or of anything you're doing at the moment? This is not a promotional session. If you come just to promote, it's probably best to leave. And likewise, okay, thanks. The ticket size of high has gone down, the deal value has gone up. Correct. And typically because the actual value size of companies have actually gone up, I said the valuations have as well. So, and they typically just like to put in more and more amounts into the actual different deals. The other one, the increase, this has been the biggest trend. This has been the biggest one that I've seen over the last profession. Correct. And also seeing that not only in Australia as well, but also through in the UK, seeing that as well, and also in the US. This one's I'll say the mentioning about increased retail investor participation has also been interesting for me over the last couple of years. Really, COVID brought that on. When the stimulus checks went out, you saw basically the rise of the retail investor, and that was both in small cap stocks and that was also in equity crowdfunding too. So over the last couple of years, you've seen record investment into equity crowdfunding because lots of people had a spare $100, $500, $1,000, and really it's punting at that sort of level, right? But because of the stage of the businesses they're going into, but that investment, allows companies to basically invest in what they need to move to the next different stages. So there will be, in each of those, there will be a lot more coming forward. So you're going to see a lot more personal investment from high net worths. You're going to see a lot more people experiencing exits and then reinvesting back into the ecosystem. There will be more funds that get launched and looking to invest into the space as well. There will be more syndicates created also, and then obviously the platform side as well. I said that's obviously a role we play in, and it's that the whole space, not only is it growing, it's growing very, very quickly, and a lot more people are looking to get involved. And there's some other factors I'll mention sort of after I cover this. And then obviously the retail investor participation. What I'm curious about is I'm interested to see how over the next 12 months, if inflation does, so if you think about if inflation does sort of, I know the US has sort of kicked it down the road for another sort of 5 to 6 months, but I said if we do have rising interest rates and then continue to have challenge with inflations, and that impacts, really, I suppose salaries or just effectively, the discretionary spend that investors have, how that impacts at the retail investor level. And also, I think one of the challenges that equity crowdfunding will have over the next couple of years is they really haven't had that many exits. Peter probably knows exactly how many they have. I know they flag one. Typically, there's been about sort of 3 or 4 that have been flagged, but effectively it needs to see, typically the way this space grows is through reinvestment of cash. So effectively, the more wins that retail investors have, the more they'll invest into more, but they need to experience those wins across the next 3 to 5 years, etc. Ask that at the end, Brinda, and I'll do my best to answer it. So just that's a good question to sort of go at the end. And then this last one I think is really important. It's just the increasing size there should be increasing size of funds being raised by VCs. They're getting a lot bigger and they will continue to. So effectively, the way this space works is that when you start out a fund, they typically start out small, and then over the next sort of 5 to 10 years, they basically exponentially grow in size. And it's typically comes with, they tend to have some big wins in their portfolio. They said they've got their ratios, whether it be 1 in 10 or 2 in 10 or whatever it may be, but those companies, that helps grow the size of the portfolio, which then helps them raise capital for the next follow-on rounds and so forth. So it starts to escalate fairly quickly, but you will start to see more the increase in size of funds being raised. Venture capital risks. So here's the things which are going through my head as far as here's the factors that could potentially impact my capital raise, your capital raise, and just our general space. Inflation and interest rates, this is sort of forefront of mind, and how this sort of really got my attention was just watching what's happening in the US. Effectively in the US, you've got that sort of, when you're watching US listed stocks, you've got that dance between value stocks and innovation stocks. And, I said I've become a big fan of Cathie Wood and ARK Invest and effectively their philosophy and how they think about things. And also you become quite interested in understanding that sort of value investor mindset as well. So there's this constant battle between value investment and innovation. And you realize that in the last few months, the innovation investment has lost, right? And what happens is you've got to understand that most Australian, and I'm speaking from the high net worth perspective, which is our market that we sort of target, and same with family offices, They are invested in small to mid cap tech companies, both in Australia and the US. So if they're down, anywhere from 40 to 80%, which some of them are, and they're still holding, that impacts their appetite for what they want to spend in the discretionary side into private companies. So for example, I've had some of my investors that tell me that they use their wins on the listed market to have punts in the private space, right? Just to simplify it for everyone, but effectively to understand that, this small to, like, one of the things that you should continually watch is what's happening in the small to mid cap listed tech companies. I said most of you would have heard about Peloton. Peloton is just an example of hundreds of them and what's actually happening. There's lots of small to mid cap tech companies that have had their valuations reduced from anywhere from 20% right through to 80%, right? And that does impact the confidence of people investing into more and more private companies. So this does sit in my mind. One thing that is nice is, as I said, the US Federal Reserve has kicked that discussion down the road for another sort of 3 to 6 months. So effectively, when they did that over the last couple of weeks, you've seen the way that markets have actually responded to that. But I said it's really interesting for me to observe that and to be thinking about how this actually affects what we're thinking from a capital raise. The decrease in discretionary income, that to me is something that's crossing my mind, in the sense that the price of just general things we buy from, whether it be petrol, grocery store, etc., is going up. And therefore that is going to impact people's incomes. Likewise, the loan size that people are taking out to purchase properties, etc., is also going up, and that could impact it. It's a factor. Said for some people, it's not going to matter. People that have assets, it doesn't really worry them that much. I think that more hurts sort of at the bottom end of the actual market, not so much in the sort of, when companies are in that sort of, you can put it in the commercialization growth stage, I think is fine. And also in later growth stage won't be impacted by that. Just to me, that sort of more impacts the seed level companies. The crypto winter and a potential crypto bear market. I'm not sure exactly. I'm a crypto investor, so I'm not really sure where it sort of sits at the moment. If you spend too much time on YouTube, you'll realize everyone throws up different charts claiming everything, but no one really actually knows what's going on. It's a wild market that has actually gone up quite a lot over the last few years. And be very, very clear that there's a lot of crypto investors that have made a lot of money over the last 2 years and also over the last 6 years that are now looking to invest into private companies. So, when typically crypto is winning and people tend to cash out, they tend to reinvest this back into venture companies or back into the ecosystem of crypto, right? So if there's anyone on here that's sort of in a sort of Web 3.0 related business, it's important to understand that when the market's booming, money flows, right? But if there's a potential of a crypto winter or bear market, it's amazing how much that changes. Like, I've watched companies that are now success stories absolutely struggle to raise money during a crypto winter and a bear market. So, and however, I'm also well aware that people are up over a lot over the last couple of years. And for me, with my next raise, I'll be looking to facilitate, if people are looking to invest via crypto, I will look for a mechanism to convert that from crypto to fiat, right? So for me, I said, this is a potential risk to our space that I'm thinking about. COVID was one of the things that I mentioned, in that, a lot of us have got used to pitching to investors on Zoom, on Google Meet, etc. The thing is that, really at this point in time, everyone wants to call the pandemic as done. The reality is we just don't know. And also we're very well aware that governments and media and healthcare institutions aren't quite willing to just let it go. That if there is massive outbreaks, or if there is massive case rises, if there is increase in deaths or people in ICUs or so forth, that they will be willing to lock down again. And then for companies that aren't in the, let's say, that don't benefit from a sort of COVID environment, they get massively impacted, right? So it's just something to keep in mind. And I doubt governments, desire to throw more money at it would probably be a lot less. And you're seeing businesses impacted by that now that aren't receiving any benefit. So once again, that also factors into my mind. And some people that were, prior to, so even during COVID, that are now sort of not getting any government benefits, but are still being impacted by lack of people coming into CBDs or lack of people dining. Got to remember, investors do come from, from retail areas or from hotel areas. Like where investors make their money matters, right? So, a lot of those investors that could have been potential investors may be out of the space because they have to fight for their own survival for their own businesses. So, said always be conscious of that. The last thing I'm going to mention is that I think it's important, and this is always something that's in my mind, is increased competition. Crypto is now, so effectively, how I define as competition for our space is that any investor that's looking to invest into an asset that has that potential of a 5 to 10x return. So angel investors, high net worth investors, venture investors, they aren't investing into your business, to basically get a 20% return, or a 10% return every year. They're looking to understand how they can 5x and 10x their money over a sort of 3 to 5 year period. So that's where I think about what competition is for our space, right? So crypto is absolutely competition, right? In the sense that there are investors that may have been investing into venture previously where they've discovered that, you know what, I can get significant returns by investing into Ethereum, for example, which is what we saw in sort of 2021. That becomes competition for capital, right? We're all competing for capital across every different area. Small to mid cap tech companies. Now, while I highlighted their, the amount they've gone down, you must understand that for investors that really back this as an area, this becomes an opportunity. Like for me, some of my investments that I've made have been into this as an area, companies that I believe in, that are tech companies that have been impacted by this, that I decided to buy more, right? So once again, that becomes competition for capital because we've seen during 2020 and early 2021, some of these companies have 5 and 10x in that time frame. And this is the reason, and you'll find there's a direct correlation between investors that love the small cap and mid cap space as well as they love investing into the private and venture space as well. So they become competition for capital. And I said, we've had it plenty of times where, in fact, one of my shareholders invested into one of our small cap clients and they 10x'd in the space of 1 year. Now, I look at that and think, well, I didn't 10x for him in 1 year, right? But that's my competition, right? That is my competition for when he's thinking about his next investment, that's competition for capital. So that does cross my mind. Funds investing into this space versus high net worth investing direct, right? So do understand that will also there'll become more competition in that. And then also the increasing amount of new and existing companies raising capital. So I just clarify this point number 3. What you'll find is with more funds coming into this space, the funds will also be looking to raise money from the high net worth, the family offices, the insto investors, etc. So they then become competition for them investing into you directly. So effectively what this will mean, let's say a high net worth is looking at investing into a certain type of business. They may think to themselves, well, look, I don't have the time, energy, or headspace to do DD. I may as well put money into this fund. If there's any real winners in the fund that they invest into, they're going to do the work, they're going to do the due diligence, they're going to do the investment management. If there's any big winners in that, then what I might do is I might just back those additional winners. That could be the psychology of investors going into funds, right? So once again, they become competition for you as a company raising capital directly because they just think I may as well just invest in the fund. The increased amount of new and existing companies raising capital. Effectively, it's just highlighting. If you think about every successful story you hear about someone selling, they're basically going and creating another business. So there is no shortage of companies being created. And you've got to literally understand that there's tens and hundreds of thousands of companies being created every single year. And they're also going to be going through capital raises as well. The part where I would never say that, Jeremy. You know me by now. But effectively, you said there'll be a lot more new, and this is a beautiful thing to see, right? Because competition is a good thing. The more companies that get created, also will come with that, the more investors that will come into the space, etc. But you've just got to be aware that you have got strong competition for capital. And if you don't realize that, then effectively, I said, you're starting it. Said it doesn't matter how unique your idea is, right, or how passionate you are about it. Just know that every single investor is being pitched by 20 or 30 other companies that are just as passionate as what you are, right? And looking for opportunities. So then the question is how do we, what is the sort of deal preference, and then what are the typically investors looking for? How am I going for time, by the way? Wow, I'm talking much more than what I thought. Deal preference. Typically, we're seeing, obviously, ordinary shares is number one that we're seeing the most. Pre-IPO is obviously high, is obviously always desired from investors. The other one I'm seeing a lot more of is convertible notes and also safe notes. I'd say convertible notes more for companies in the growth stage or that sort of thinking about pre-IPO. Convertible notes are a phenomenal way to raise capital and have been very appealing to investors because they come with the potential growth upside, and also they come with a yield attached to it as well. So they come with a payment, with a coupon rate attached to it. Safe notes, I'm seeing more and more. I'll just give us advice. Like, obviously, safe notes are an effective instrument. I'll just give some advice that one of the things I'm personally observing is that people are using safe notes as a way to defer the valuation, right? And I get that completely. And then they're coming up with ridiculous valuations and they're using metrics which makes no sense. Like, I was speaking with one founder, and I'll just make sure they're not on because I don't want to offend them. Basically, I was doing a deep dive with that founder about what different things that they've done. Just making sure. I said, I'm just conscious that but they when they were raising for their business, they were trying to create a valuation for their business at 4 times, right? 4 times what they'd previously raised at, 2 years ago. Now, the challenge with that is it sounds exciting to you because you feel like you're building the value of your business, you're building your net worth and so forth. But the reality was not one investor had put in money anywhere near the valuation which they were saying that their business was worth. Right. In fact, the closest was 25% of that value. And I think that's important to realize, because if you do not be honest with yourself about, the valuation part, safe notes can, end up being a nightmare for you. So anyway, just some of my observations on that. And then I got asked a question about SPACs. Interestingly enough, SPACs are becoming popular. So obviously in the US, they've become popular over the last few years. Effectively, the way it got explained to me, a SPAC is a special purpose acquisition company. Effectively, it's companies that list on a stock exchange and they've got a blank check. So effectively, they list on a stock exchange with 100 million cash, as an example, and then they've got the ability to acquire whatever asset they want to. And it's become a way for sponsors and VCs. I'm seeing a lot of VCs doing SPACs. A lot of my friends in Singapore have actually done SPACs or are looking to do them. And they do that for ways to, number one, raise money. They get fees on the way in, they get access to equity, etc. I'll just flag that, effectively, SPACs for non-revenue producing companies haven't turned out too well, and highly speculative companies. By the way, sounds like good old backdoor. It pretty much is. It's not really a backdoor listing, Peter, but it's more in Australia they call it a LIC, a listed investment company, right? So, but it's sort of got a slightly different structure. The ASX doesn't allow it. The Singapore Stock Exchange has just allowed it, but I'm seeing now that there's investment groups that are coming to Australia looking for SPACs. Like, we've had them speak at our conferences. I get more and more questions about it. Effectively, at some stage, and look, to be honest, you'll see a lot more Australian companies actually go down that path. It's a way to actually list on the US market without having to pay massive amounts of fees to go through the IPO process. Someone else is actually doing all the organization work. You're guaranteed your funding as part of being acquired by that business. And then you can go about actually building it. And you've seen companies like Grab take advantage of that. And then also, just gone from my head, you've seen Catcher Group do their own SPAC. You've seen Vicar Ventures, like big VCs in Singapore actually doing that. And
I just wouldn't be surprised if you'll see that as competition for some of the later stage growth companies in Australia, that they will go down that path. So our guidance, really simply, raise as much capital over the next sort of 6 to 9 months, in the first 6 to 9 months of this year. Just the reason being is that we're really, as I said, the US Federal Reserve has kicked the can down the road in terms of interest rates. There's typically a 6 to 9 month gap between when you see moves like that and then how it impacts venture funding. So if there is a massive, so if inflation gets even more out of control, which, you know, to be blunt, in the US it is, and in Australia it's probably about half of what the US, you will see that start to potentially impact our space. And I say that because for me, when I come into this space, you know, there was much higher interest rates than what there are now. And I saw how that impacted funding. And, you know, none of us can get complacent with the ability to get capital as it is at the moment. And like all those beautiful numbers that Peter shows via Tech Board, as far as how much capital is expanding and so forth, never get complacent, because if there's big structural market shifts, that disappears. And I've gone through environments where it's been incredibly hard to raise money for anyone across a 2 to 3 year period. So complacency is not the thing to get when it's like this. Execution of business milestones will be key. And I said, there's less and less money for ideas from what we're seeing. A lot of people are talking about it, but really, you know, a lot more people are they're looking to fund growth companies more so than ideation companies, if that makes sense. So you've got to work hard on the milestones. There is still capital for, you know, companies in that sort of seed stage, but do understand that there's a lot more capital. But like, once again, it looks like that, you know, the capital available, like those charts are the perfect example of what it looks like for when you're actually raising capital. That first 1 to 2 million feels like an absolute nightmare, and you just, you know, you feel like, how can I put it? You feel like you're begging for people to invest. But as you go through the growth stages, you'll see that whilst it's still hard work, the capital available is significantly more. Capital raising, you know, said we're always a fans of always be raising, as we don't know what sort of disasters or opportunities are around the corner. But effectively, for companies, if they have the potential to raise significant amounts, look to raise a good sort of 2 to 3 year runway, just for the fact that if there is funding challenges down the track, you're obviously very well set. And then understand what it is, you know, what is the exponential, okay, sorry, there shouldn't be a question mark here. Understand what is the exponential potential of your business. So I say, so in my conversations with a lot of different investors, is that they don't, when they're looking at businesses, they're genuinely trying to understand is how do they get that sort of 5x to 10x growth? Is there any, so let me just take time for questions. This more part is just general, right? So that's my sort of outlook done. This next part is, I think, more, I don't know if it's business, it is business specific. It's how to think about, it's more from how to think about your business for going forward. Someone asked a question around, where is it? Blah, blah, blah. Does using ECF reduce credibility with VCs and larger investors? Peter, you may be able to answer this. How many VCs have backed companies that have raised capital via equity crowdfunding? How many companies have raised equity crowdfunding first and then gone on to raise money from VCs? If you're not there, Peter, let me know. Otherwise, I'm speaking to no one. Yeah, I can only think of one, and that was Car Next Door, that just got acquired by Uber, and we also helped them raise through high net worths. Okay, so that may highlight it to you. What about the concert? How many, if any, ECFs that occur, equity crowdfunding that occur in an earlier round from a VC? Not yet raise that money. Yeah, I think that's a bit, yeah, it's interesting. It said it's not as many as what you may think, but it is possible. But It's really, every business is different. Like I did see one where there was a co-investment recently, where basically so look, equity crowdfunding for B2C businesses is pretty much a logical pathway, right? When I say that, it's a way for people that are passionate about what you do to potentially invest into your company. But also understand that a lot of companies that do equity crowdfunding typically have are raising at higher valuations than what most of high net worth or VCs would be looking to participate at that stage. So when you've got that situation where there's a VC going in at the same valuation as retail investors, that's a unique scenario. But it'll be really interesting to see. I said they may be doing it, but have they actually secured that money? Anyway, it's an interesting part. And then the other part is, as I said, typically you find that high net worths and family offices typically invest alongside each other. And VCs typically invest alongside each other, more so than VCs investing alongside equity crowdfunding. It's a good question, Samir. As far as for travel startups that are raising funds, I think that'd be a hard one. Like I think people are excited about the rebound. You see that with some of the listed stocks, but if you've traveled recently, traveling is not as fun as what it used to be. That's all I'll say. Like I've just come back. I came back from Korea about a week and a half ago. Yeah, it's really, I said, it's not easy to think of, one that did that. Anyway, yeah, I used to come back from Korea and traveling is definitely not as fun as what it used to be. So my concern going forward is that people will travel less. You'll see that obviously with the onslaught of I suppose virtual reality or VR sort of becoming, and also the metaverse and so forth, I wonder how that's going to impact sort of travel. But look, the reality is there's always winners, right? There's always people that do come up. Basically what typically is going to happen is the business model is going to change. So when I said travel startups, I was obviously immediately thinking about international. But let's be honest, local areas have boomed. If you look at Australia as an example, whilst international travel has gone through the floor over the last couple of years, what's boomed is like domestic, like basically traveling interstate or to areas that are more interesting. Like that's actually gone through the roof. And Airbnb has been a good example of a company that's still been able to do incredibly well, even with all the different travel restrictions. The ones I worry about, I saw a company that's doing international weddings. And it's like, that's one may continue to struggle. Okay, well, I'm going to get onto this one. So Sanjay, you've asked a question about new technology. I might move on to my next one. So this is what I spend a lot of time thinking about at the moment, right? So for WI, obviously we've done really well with the baby boomer market and really Gen X, right? We spent the majority of our subscriber base would be in this actual area. Reveals scale of pent-up travel demand. Yeah, say that, but said there may be surveys about it, but let's see what the actual spending looks like, because I said I've been on planes and they don't look exactly quite full, right? There may be for business, but actually from the retail side, it will be interesting. Let's see what that comes out. And I'm just talking about international travel. So look, our space, we've pretty much done a lot of work with baby boomers and also Gen X. But, when you realize that going forward, really the markets that I've got to be thinking about for myself, and also is really around Gen Y and also the millennials and also Gen Z, because effectively, there's a couple different factors having. Firstly, millennials are coming into their peak earning power, their peak, and with that, basically you'll notice that a lot of them like to reinvest into early stage companies, right? We've sort of grown up on the internet. Whilst we do remember phones, I said I sit right in between sort of, right on that sort of Gen Y, because I was born in 1980. All this makes sense to me as far as things that I like to experience and how I think about things and so forth. And if you look at Gen Z, it said effectively it's a completely different market altogether. However, it's the rise of the retail investor is starting to have a massive influence in what's actually happening in the space. So this is one of the factors that sort of got my attention, and it I sort of come across this a year ago, and it was published in the AFR as well, in that in the next 15 years, they said this in 2015, of the next 15 years, $24 trillion of wealth will be transferred in the US. In Australia, $240 billion a year for the next 15 years is going to be transferred from baby boomers to millennials. Now, why that is so interesting is because that's going to govern what investment looks like over the next, and we need to think about this whilst we're all stretched, whilst we're all working hard for revenue and for raising money this year, we also need to think about who are our future investors and our future customers 5 to 10 years from now, because at some day that time will come. And you notice that Gen Y and Gen Z, access not ownership is the preference, right? So they prefer to rent things, and the sharing economy is quite prominent amongst Gen Y and Gen Z. And this is interesting, right? 25 years from now, car sharing will be the norm, and car ownership an anomaly. And I just mentioned about car next door. They're literally the example of that, just recently been acquired by Uber, right? Wellness is obviously a massive area, right? We know that. I said, I'm wearing a band right now, that tracks my sleep, tracks my exercise, etc. I'm sure a lot of you are doing that as well. I'll come onto that in a second, Craig. And then you can see this is growing up a lot, and you can see the reduction of basically said percentage of 12th graders who disapprove of people 18 or older smoking 1 or 2 packs of cigarettes a day. Seems like vaping is completely okay, but smoking cigarettes, not so much. But wellness said, it's interesting how much money is being spent on wellness. And you see it with brands like Gymshark, you see it with stuff like Whoop, with fitness watches, etc. This is a big one. And I think this is one that everyone has to be very, very conscious about, right? It's basically ESG, environment, sustainable, good. Yeah, very relevant to you, Jeremy. I picked this one as a stat to come up, is about EVs. This is actually underestimating how big this is going to be going forward, right? So effectively, I think over the next 10 years, EV adoption will be, so if you think, and actually I'll explain why in a second, I won't mention it too much now, right? But so it will grow from EV sales, sorry, my stats are wrong there. It will grow from 2.5 million, right? Not 23.5, from 2.5 million to 31.1 million over the next 10 years, right? To give you some perspective. And obviously plant-based protein, and then the other one, bioengineered meat. They're working on the bioengineering of meat. Like, think about this, the entire cattle and dairy industry that we know is up for disruption. They only need to disrupt 3% of the ingredients, right, to actually get this. And then you've got all the plant-based products that are coming out at the moment, right? You can see how fast that market's actually growing. This whole area will completely transform, right? And so my mentor's lesson was, he gave me the example of Airtasker and HighPages, and he was looking at investing into two. And you notice with investors, they typically have a space that they want to invest into, and then they go and look at all the companies in it. And when he met with one of the companies, he asked them, what's the makeup of your team? And he said, well, and one of them, they had, I think it was 12 engineers and 3 salespeople, or 3 sales and marketing people. And then the other one had 20 salespeople and only 3 engineers, or 25 salespeople and only 3 engineers. He invested into the first company, right? And that first company was actually Airtasker. And the reason why is because he wanted to invest into a business that had an exponential opportunity and had infinite verticals that could go down. Because with humans, you can only grow a business by so much. But when you're actually growing by technology, the potential for that business becomes a lot more. And when he taught me that, it did really shape my thinking about how I should be thinking about my business. Because at that stage, I was thinking about how I grow by bringing on more salespeople, right? And the factors which have got to come into your mind is understanding this. And I learned this from ARK Invest. I left the logo on there. I highly recommend follow Kathy Wood. Even if you're not an investor and if you're just busy doing your stuff, follow Kathy Wood. She will shape your thinking in the right way based on how she talks about the way she looks for investment opportunities. So she highlighted that one of the biggest trends is, most people talk about Moore's law for computing. She highlighted Wright's law, in that what he discovered was basically the more you manufacture, the more the cost comes down. So Solar panels, for example, are now solar energy is now the cheapest form of electricity ever being produced, right? And it's going to keep on coming down more and more. Then if you look at areas like batteries, for example, energy storage, battery cells, the cost of batteries are coming down. Genomics has gone through the floor. It used to be $1.5 billion or something to sequence a genome. Now it's under $1,000. Right? Those are going to keep on coming down. The biggest one that's important to most of us is the cost of training AI models, right? It used to be incredibly expensive, but now it's becoming a lot more affordable that companies like ours, like yours, can actually invest into AI to create that exponential opportunity and to produce at a scale what we're doing with our businesses. And AI impacts everything, right? So Wright's Law, I find super interesting. The other one is adoption curves. So to understand that, and I even think about this for my space, it just sits in my head that I still feel like platform-based businesses in this venture and investment space are still in the early adopter phase, right? Because most of this space is driven by mate who knows mate, who introduces company to mate, and mate invests. That's pretty much still how this space is driven. VCs still spend a lot of time building up their personal introduction networks to get introductions. As much money as people highlight has come in on equity crowdfunding platforms, it's nothing compared to what comes via capital markets and via the funding style, whether it be said by personal introductions or networks of people who own networks. So, and if you look at likewise with solar, renewable energy, ESG, even as an example, the adoption is just accelerating at a massive space. So that's always in my head about businesses at what stage of the cycle am I in this adoption curve space, and then what opportunities, and investors are thinking about this as well. The other one which goes through my head is Metcalfe's law, and this is what I love about my business is the power of an ecosystem. One phone is worth nothing. 2 phones is worth something. 1 million phones, you've got network effect, and that's Metcalfe's law. So someone's asking questions about crypto. Crypto is the perfect example of Metcalfe's law. What is beautiful about right now is that for all of us founders right now, we have an opportunity to generate more wealth over the next 5 to 10 years than what we ever would have over the last 20 years. And the reason being is all the things I just highlighted before. Things like AI, the way it helps us, whether it be improve efficiency across our businesses, things like adoption curves and things like Metcalfe's law. There's platforms now which allow us for our businesses to go out to literally billions of people via those platforms. That's the power of Metcalfe's law. So Bitcoin obviously shows an example of that. I know Ethereum's used an example of Metcalfe's law, etc. The more nodes that are on the network, the more people that are in your ecosystem, the more people in your community, the more value that community becomes. So really do think about that for your own businesses. But those 3 factors make such a big difference, whether it be, Wright's law is thinking about how can you produce what you're looking to produce, even if you sell software, how can that be produced more efficiently going forward, right? And how can you do different areas? Like I said, every area now is impacted by AI. Even copywriting is impacted by AI at the moment. And understand that markets will move towards efficiency. All markets, whether it be capital raising, whether it be in our businesses, all markets move towards solutions which save time, save money, and improve efficiency, and that's our job to do it. The problem we don't know, and I said I love using this as an example, in that said every 5 years, we've got to reinvent our businesses in different ways, and we've got to no one was said people had great experiences. My generation had great experiences going to Blockbuster, except if they had fines for bringing up videos late, but they were disrupted by efficiency, right? And same with taxis, same with Uber, right? It's small things that can make a big difference. AI, as I said, I won't harp on this too much, but it's like, how can we utilize AI across our business and what difference can it actually make? All of us are going to be able to use AI. We're going to be buying software that has AI. We're going to be implementing software into our businesses. And we're going to make sure that we basically use, at some stage, analytics. What we learn about how we grow our businesses will also be via AI. Crypto, said big fan of crypto. And look, what goes through my head is at some stage, there's all these trends, and you've got to remember, this is a $1 trillion industry that's been created out of nothing over the last 10 years and is growing at an exponential rate. So at some stage, you know, whether it be all the different financial technologies being created out of it, whether it be capital raising, whether it be, said, the different DAOs, whether it be NFTs, whether it, at some stage, if we have communities, if we have capacity, you know, to create tokenized models, companies will start to look at it more and more. I said, and you're seeing that. I said it's small at the moment compared to the entire space, but someone mentioned just about fractional ownership, right? I said there's great opportunities in fractional ownership. One of our clients, Bricklet's, done incredibly well in attracting large investors for it. As housing prices become more and more unaffordable, fractional ownership becomes more possible. The thing to note around all these areas and to think about with our businesses is when we're growing it, a rising tide lifts all boats. So there's all sorts of different ways that we can generate opportunity around the fringes of our business if our sector is in that space. People have created so whilst Uber's made a lot of money, so have all the drivers, so have people financing cars. You know, there's been all sorts of different layers of finance. They finance hardware, software, logistics, services, support, raw materials, infrastructure. All that goes and makes money. And the best part is that not only does it surpass what was initially there, it goes and increases it, you know, by 10x. So that's why, for me, I'm excited about the next part. So what we're seeing, these are the key sectors that we are seeing getting most interest at the moment, just to sort of, as we're finishing up here. Software and marketplace businesses with strong traction metrics, Web 3.0, renewable energy technology. I'd also say circular economy as well. So effectively, it's fitting into that, the recycling of materials and the reusing of materials. So the circular economy will become another big trend as well. Healthcare, health tech and life science, AI as a platform technology, and then agri-tech. They're probably the biggest areas of interest we're seeing. So that's pretty much the end. I'll just give a quick flag is that what's coming up for us is our Emergence conference. We are hosting it on 9th to the 11th, 9th to the 11th in Sydney, and then 28th of March in London. Effectively, we'll be showcasing sort of 90 to 100 companies across 3 days in Sydney, and then in London, we'll be showcasing 30 companies. I think we've already got something like 1,200 or 1,300 registrations for the Sydney one, which is phenomenal. But yeah, very exciting, and we're very close to sort of finalizing all the sort of companies that will be participating for that. So I hope that got some value. If you've got any feedback from me, please send it through on LinkedIn or send it through on my personal email. I do want to do this more often. And look, I said, I'm absolutely not an expert, but I just want to try and highlight what things I'm personally seeing, as well as information that is publicly available to everyone, and my sort of summary of it from, yeah, I don't know. It's just, I've got an interesting perspective. So if I can share it and if I can help or add value in any way, I hope it does that. If not, I apologize for wasting your time. All right, everyone, I'm going to finish it there. Hope everyone has a good evening, and all the best.